the Mastery Mindset podcast channel. The Wealth Series. Master your mind and unleash your potential. Hey there, fellow achievers. Welcome back to another exciting episode of the Mastery Mindset podcast channel. Today we've got a financial topic that's sure to pique your interest. We're talking about bonds and fixed income investments. Now, before you hit that pause button thinking it's too complex, let me assure you, we're going to break it down into bite-sized pieces and explore this fantastic world of stable returns. Let's kick off our exploration by delving into the fundamental concept of bonds. So, what exactly are bonds? Well, think of them as financial agreements, somewhat akin to IOUs, issued by either corporations or governments. When you decide to invest in a bond, you are essentially acting as a lender. In exchange for providing your capital, you enter into an agreement where the issuer promises to make regular interest payments to you, which are often referred to as coupons. Additionally, you'll receive your initial investment, known as the principal, back in full when the bond reaches its maturity date. To paint a clearer picture, let's consider a hypothetical scenario. Imagine you have a sum of $1,000, and a friend approaches you, asking to borrow this money. They propose a deal where they will repay you $50 each month, and after 1 year, they'll give you back the full $1,000. This simple illustration mirrors the essence of how bonds operate in the financial world. You're the lender, your friend, or the bond issuer, provides regular interest payments, and ultimately, your original investment is returned to you when the agreed-upon time frame is met. This is the core mechanism behind bonds. Now that we've got a grasp on what bonds are, let's venture into the diverse world of bond types. There's quite a menu to choose from, including government bonds, corporate bonds, municipal bonds, and an array of other options. Each of these bond types carries its own set of unique characteristics and associated risk levels. To make this concept more relatable, think of it as perusing the menu at your favorite restaurant. Just as a restaurant offers a variety of dishes to cater to different tastes and preferences, the bond market serves up a range of options to meet diverse investor needs. Let's break it down further. 1. Government bonds. These are like the reliable burger on the menu. Just as a burger is a safe bet at your go-to diner, government bonds are often seen as a dependable choice in the world of investing. They are issued by governments and are considered relatively safe because they are backed by the full faith and credit of the government. Investors typically expect steady, albeit modest, returns from government bonds. 2. Corporate bonds. Picture corporate bonds as the gourmet dish on the menu. They offer the potential for higher returns compared to government bonds, but they come with a bit more risk. Corporate bonds are issued by companies to raise capital for various purposes. The risk here is tied to the financial health of the company. If the company encounters financial difficulties, it may impact its ability to make interest payments or return the principal amount. So, like trying an exquisite gourmet dish, investing in corporate bonds can bring more reward, but it also carries a degree of risk. By understanding these different bond options, you can tailor your investment choices to your financial goals, much like selecting a dish that suits your palate at a restaurant. It's all about finding the right balance between risk and potential reward in the world of bonds. Now that we've explored the various types of bonds, let's delve into why you should seriously consider adding bonds to your investment strategy. Bonds have earned a reputation for stability and providing a consistent stream of income. They can play a crucial role in your investment portfolio, particularly when you're aiming for reliable returns while managing risk. To help you visualize the importance of bonds in your investment mix, think of your investment portfolio as a well-balanced diet. Just like a balanced diet includes various food groups to meet your nutritional needs, a diversified investment portfolio comprises different asset classes to address your financial goals. Bonds, in this analogy, are like the protein source in your diet. They offer strength and stability to your overall financial well-being. Much like how protein supports your physical health, bonds provide a stable foundation for your investment portfolio. They offer a predictable stream of interest income, akin to the sustenance that protein provides for your body. On the other hand, stocks are like the veggies and fruits in your diet. They bring that extra kick of growth potential to your portfolio. Just as fruits and veggies contribute essential vitamins and minerals to your diet, stocks have the potential to deliver higher returns over the long term, helping your portfolio grow and flourish. By including bonds in your investment strategy, you're essentially ensuring that your financial diet is well-rounded. This balanced approach can help you weather market fluctuations more effectively and work toward your financial goals, with a sense of stability and confidence. So, whether you are aiming for financial strength or growth, bonds have a valuable role to play in your investment journey. Now, as we continue our journey into the world of bonds, it's essential to acknowledge that it's not all smooth sailing. Bonds, like any investment, come with their own set of risks, and being aware of these risks is crucial before you decide to invest. To help you grasp the concept of these risks, let's draw an analogy to navigating a ship through unfamiliar waters. Imagine you're at the helm of a vessel, and your investment in bonds is your voyage. Here's how the risks relate to this maritime analogy. 1. Interest rate risk can be likened to the unpredictable weather at sea. Just as storms can appear suddenly and disrupt your course, interest rate fluctuations can impact the value of your bonds. When interest rates rise, the value of existing bonds tends to fall, potentially leading to losses if you need to sell them before maturity. 2. Credit risk is akin to hidden rocks beneath the surface. As a sailor, you must be cautious of submerged hazards that can damage your ship. Similarly, credit risk involves the potential for the bond issuer to default on their interest payments or, in the worst-case scenario, fail to repay the principal amount. This risk varies depending on the financial health and creditworthiness of the issuer. 3. Inflation risk is comparable to a slow leak in your vessel. Just as a gradual leak can erode the integrity of your ship, inflation can erode the purchasing power of the income you receive from bonds. If the interest payments from your bonds do not keep pace with rising prices, your real returns may diminish over time. Understanding these risks is essential when navigating the bond market. Much like a skilled captain anticipates and navigates through challenging conditions at sea, an informed investor can make prudent decisions to manage these risks in their bond investments. So, always keep your eyes on the financial horizon, be aware of potential hazards, and make well-informed choices as you set sail in the world of bonds. As we venture further into the world of bonds, it's essential to discuss the strategic aspect of investing. How can you construct a well-diversified bond portfolio that aligns with your financial objectives? Let's delve into the art of building a bond portfolio, emphasizing the significance of asset allocation and selecting the right bonds tailored to your unique financial circumstances. Imagine creating a bond portfolio as akin to assembling a jigsaw puzzle. In this scenario, your financial well-being is the completed picture you're aiming to achieve. Each bond you select represents a piece of this puzzle. Here's how this analogy helps illustrate the process. 1. Pieces that fit. Just like you seek puzzle pieces that seamlessly fit together, you want to choose bonds that align with your financial goals and risk tolerance. Some bonds may be better suited for income generation, while others could provide potential for capital appreciation. Ensuring these pieces align with your overall financial strategy is crucial. 2. Completing the picture. As you piece together the puzzle, your objective is to complete the image in front of you. Similarly, your bond portfolio should aim to fulfill your financial objectives, whether it's wealth preservation, income generation, or long-term growth. Each bond you add contributes to achieving this financial picture. 3. Diversification. Just as a well-rounded puzzle includes a variety of shapes and colors, a diversified bond portfolio includes different types of bonds. This diversification helps spread risk and can enhance stability. It's like having a variety of puzzle pieces that make the overall picture more resilient to disruptions. 4. Risk management. If you encounter a missing or incorrect puzzle piece, it can disrupt the whole image. Similarly, effective risk management in your bond portfolio involves understanding the risks associated with each bond, and ensuring they align with your risk tolerance and financial goals. In essence, constructing a bond portfolio is a thoughtful and strategic process, much like assembling a complex puzzle. The goal is to select pieces, bonds, that harmonize with one another, ultimately completing the financial picture you envision. By carefully considering your objectives and the characteristics of each bond, you can craft a bond portfolio that brings your financial goals into focus, ensuring a more secure and prosperous future. As we come to the end of this enlightening episode, let's take a moment to recap our journey through the world of bonds and fixed income investments. I hope that by now, you're feeling more confident and informed about this crucial aspect of financial planning. It's essential to recognize that bonds aren't exclusive to the financial elite. They can serve as a stable path towards realizing your financial aspirations. Before we bid adieu, I want to express my heartfelt gratitude for joining us today. Your support fuels our passion for bringing you valuable insights. If you found this episode helpful, don't forget to hit that subscribe button and share it with your friends and family who can benefit from this knowledge. In conclusion, bonds and fixed income investments may not always steal the spotlight, but they are the steady, reliable drumbeat in your financial journey. They play a pivotal role in ensuring that you navigate your financial goals with unwavering confidence and security. So, as you continue on your financial path, remember to stay financially savvy and maintain that curious mindset. It's this mastery mindset that will propel you to heights you've never dared to dream of. It's been an absolute pleasure being your guide through this episode. Until we meet again in the next installment of the Mastery Mindset podcast channel, stay inspired, stay focused, and continue your journey towards financial mastery. See you next time.